right, perfect. Now, as you know, this is actually the last live stream as well for the Analyst month. Of course, we also have live streams exactly the same as in the Execution month, but we will go over different things. So this is also the last video about the Analyst month in itself. Now, I wanted to go over just a breakdown of a few pairs and a few instruments and how I would go about it in a forecast manner as well, and using news specifically. So a lot of the week can also be determined by looking at news a lot of the times. And what I mean by that is how the week unfolds is seen through news. That's why I always start with the economic calendar as well. This is something we're going to dive deeper into in the Execution month, actually, which we briefly touched on in the previous video, the last video, the Analyst month as well. Now, if we take a look at this economic calendar week right here, then we can see on Monday, we have US dollar orange folder news. Now, for the US dollar, I would always like a red folder news. Unless it's in combination with something else, I would always like to have red folder news because that is the actual volatility right there. Then that means on Tuesday, we do have red folder news right there. On Wednesday, we also have red folder news. On Thursday, we also have red folder news right there. Now, at the end of the week, we approach Easter, we approach a lot of bank holidays. So that's also when I want to take a small step back. It's not super interesting anymore. So the main part of my trading will most likely happen on Tuesday and Wednesday right there. I already know that in advance. So when we know that and we take a look at a chart, we remove this right here, then what can we see? Well, that lines up with the idea of potentially continuing higher off of this daily fair value gap sitting right there. This is oftentimes, I say oftentimes, but this is a scenario that I personally really enjoy. And what that scenario is where Monday doesn't have news supporting the ID, and Monday tends to be a consolidation. That Monday also then creates a fair value gap right there. And then Tuesday does have the news, whilst Monday is still continuing lower a little bit, consolidating. Tuesday now has the volatility to actually continue higher as well. That is exactly what I would want to see. So right here, once we come into that, right there, we sting into it, and now we have the volatility to actually continue higher off of that. We have this fair value area. You don't necessarily need to go into the 4 hour right here to mark out that 4 hour fair value area. As you may know, usually when I find a PD ray on one time frame, I stop. I don't go down a single time frame, but here to give a little bit more accuracy, I wanted to use that fair value area as well right there. Now, right here, perfectly overlapping, we can continue higher on that Tuesday right there. So Monday, we already sting into it, but Monday again doesn't have that volatility, right? Doesn't have that volatility to actually continue higher off of that fair value area right there just yet. So then Tuesday is where the magic happens. That's where we want to continue higher off of right now. Then what is the target? Well, automatically the target for me is always quite simple because it's the context high for me right there. It's the first target for me. So we're moving from daily discount rate towards daily premium rate right there. It's the context high. Now, one specific detail right here, which we have not gone, into depth, too in depth on this topic. And what I mean with that is the weekly fair value gap right there, how we can potentially trade the third candle right there. Now, the way you would want to trade the third candle is, first of all, we did a deep work session actually on this very recently, where we determined, all right, if we have no resistance anymore towards the left of the target right there before we take that high, then it is very likely that this is going to be a breakaway gap right there, which is actually quite funny because that is currently what we might actually be seeing right there. So it's a great study. Now, if we want to trade that tricky third candle on the weekly time frame, then the way we want to approach that is we want to demand perfect price action. No weird price action, nothing that might seem odd. We want to see perfect price action. And what I mean with perfect price action, when we talk about a two candle rejection, when we talk about order flow following through, creating new fair value gaps, that's exactly what we consistently want to see in order for us to still be involved. So right here on the daily time frame, we see we can move higher off of that daily fair value gap right there. On the 4 hour right now, we are creating 4-hour context inside the daily context as well, where we have this 4-hour value gap right there, which we can actually continue higher off of. So thus far, we have perfect price action. Nothing weird, nothing crazy. We have nice price action here on the dollar. And we can follow through towards that high right there as well. And that's exactly what we see. Now, as soon as we take out that context high right there, that's when I get suspicious. And why is that? Well, the reason for that is because once we sweep that high, potentially, we have that wick right there above that high, not a body closure, not following through towards the high, whilst we don't have any resistance anymore towards the left right there. That is when it becomes suspicious to me. And when I feel like, all right, I would want more confirmation if we do want to continue higher again. Where again, the main trading activity was on that Tuesday and that Wednesday right there. And late during that Wednesday, we see that weird price action happen right there. Then we follow through. And once we follow through towards the context highs, we see that we have, again, a potential sweep of liquidity instead of a run on liquidity. So that is where we have to be careful again. Now, the thing here that's quite important to understand as well is that, again, those trading, the time windows that you actually want to be trading throughout a week like this is very specific. In some weeks, it can be every day. As in, last week, we actually had, and I don't mean this most recent week that we had, but the week before that was actually tradable throughout the whole week, I would argue. It was so interesting that it was such a good week. We had such great volatility overall seen through the economic calendar. And it's such a different approach that you need to take in a week like this, where in a week like this, you need to be more careful. You have specific windows that you want to get involved in. That's quite important to understand, because otherwise, if you expect every week to be the same and similar, that's just not going to be the case. So a week like this is oftentimes a great week as well. And what we're eventually going to go into for psychology-wise, a week like this is very great to actually sit out a little bit, to not expect a lot. Because when the good weeks then come, then you need to be ready. Then you need to be very focused on price action. So save your brain points for a later day as well. That's quite important. Let me see if we have any questions before we move on as well. What is an overlapping defense in textbook sharp turn? If we don't have an odd, how far can we retrace? Well, in textbook ST, we in a sharp turn, I would argue that the overlapping defense is not there. We only have a fair value gap. A textbook overlapping defense is an internal swing high / low wicks overlapping with fair value gap, which gives you a fair value area. Exactly, perfect. Which, in that case, that's what we don't have with a sharp turn oftentimes. At least we don't have to have that. So then it just is the fair value gap itself in a sharp turn. Let's see. Let's move on towards some of the indices as well. And I think the indices, when I refer to an instrument is really not interesting to trade, or it's not great to trade, or this week the price action was just not that great, I think it's a great study. I do not think it's a pair or an instrument that we should just ignore. I think the indices right here, I was very 50-50. And I think the reason why I was 50-50 is a great reason to do your studying, because that is going to be more important eventually than actually looking at a high probability price action. Because if you find the low probability price action, you can also, of course, find the high probability price action. So it goes hand in hand. So that's quite important to understand. Now, for Russell, this one was quite interesting, to be honest, in comparison to the other indices. We were sweeping that previous week low right there, which we discussed as well in previous videos. Then we can continue higher and create this context right there and continue higher towards that swing high. So that will be most likely the target for this next weekly candle right there. It's a quite obvious weekly candle on what it's going to do. It's likely going to continue higher. Now, on the daily, what are we doing? We are returning back towards this fair value gap right there. Then we come into this fair value area right there. Low close first. Previous candle low sweep right there. Low close. So first candle does not reject. Second candle can reject. After that, we respect right there. The Tuesday, it's a little bit iffy. And the reason I mentioned that is because it's still a low close right there. Ideally, I would have wanted to see already an up candle. But again, the bias is still intact. We don't have anything to now support the idea of going lower as well. So right here, once we continue higher and we get closer towards those highs, we create quite some fair value gaps actually, continuing higher. Now the interesting part, and this is what we touched on in a previous live session actually throughout this week, is breakaway gaps will most likely form in between moving from context to context. And what I mean by that is we move from this fair value area on the daily right there, that context, towards this daily context high right there. Once we move from the context to the context, we see breakaway gaps right here getting formed. Once we take out the context high, usually, and that's the highest probability area for a fair value area to hold, is that right there, once we take out that context high, we create a new context area, discount rate to potentially continue higher off of, to then create new context as well in the form of those highs. That's exactly when you do see a return, where this fair value gap in itself is, of course, as well a breakaway gap. Now, this is a nice thing actually into a fair value area to then continue higher off of that. After we take a context high like that, especially late during that week, Thursday, Friday, I am not interested in trading that anymore. I personally would want to wait, either get involved right there or I simply miss the move. Now, then moving on to the other indices, we take a look at ES. ES, I was quite 50-50 on this. And I'll tell you why as well. So in a situation like this, where we have all-time highs and we don't have anything else right here towards the left anymore, then right here, my expectation is always that, or what I would like to see at least, is that we retrace back into that fair value area to then reevaluate. So what can we do? Can we continue higher off of that? Can we disrespect that to continue lower? What can we actually do right there? Now, in this case, we do retrace quite far into that fair value gap right there, which I already do not like, because then I would expect a retracement into that fair value area again. So that's already a little bit more suspicious to me. So right here on the 4 hour, what do we see? Do we have any fair value gaps to work with right now to continue lower off of that? Not really. We have this 4 hour fair value gap right there, which we can continue lower off of. We fail to do so. Two candle rejection actually fails right there, which is similar to Russell like we saw on the 4 hour as well, where this, or on the daily actually, this two candle rejection, that should have been a down candle. It's already a little bit suspicious right there that we do not follow through lower. Then we take out the two candle rejection, and eventually what we aim for is this previous day high. Okay, we can potentially continue lower off of that. Now, sweeps, I always want more confirmation. So for previous day high, previous day low sweep, I am not going into my usual 15-minute time frame to then look for an entry. No, I want a little bit more confirmation instead of just a very, very, very easy confirmation. And what I mean by that is, for example, 1 hour sharp turn right there, and then off of that 1 hour sharp turn to then go into the lower time frame to confirm that again. So here you create new context. The context actually that right there, because we take that out and then retrace, small little detail. Then after that, we have this context right there as well. And then it becomes that low. And of course, from the previous day high, we can move towards the previous day low. And then eventually the context low is this low as well right there. And once we take out all the resistance, we can see that we run very fast right there. Afterwards, what do we see? Again, attention to detail is that we do have that weird sort of liquidity sweep where we do not close exactly with fair value below that low, not overlapping with that low. And then afterwards, we retrace quite deep into that fair value area again. And that makes it again suspicious, where I am extremely 50-50 right here. Overall, this price action, more difficult to navigate, I would argue. And that is because it was indeed quite 50-50, no clear higher time frame premise. So then the next and the only thing, once it does start to continue higher again, that it can aim for is that swing high right there. Now, right here, I want to go over some of the Forex majors. Let's see if we have some questions before I move on. Let's see. How far can we retrace in textbook sharp turn? Ideally, just the first fair value gap. We should not disrespect the first fair value gap. Ideally, of course. Oftentimes in sharp turn, it also retraces a little bit deeper before we actually continue higher. Or lower. Would you demand more price action on Australian dollar, New Zealand dollar on Friday in case we had news? Let's see. Australian dollar, New Zealand dollar. What are we doing right here? Aiming higher towards that swing high on the weekly. Potentially creating a weekly fair value gap right there. On the daily, what are we doing? Failing to create a daily fair value gap right there. So in this case, usually when we have a situation like this, so I like to think ahead in that sense. And what I mean by that is, for example, right here, we are about to create a fair value gap, but we have to wait a day. Now, let's say the day that we are waiting for to create a fair value gap is a Tuesday or a Wednesday, and it has Australian dollar or even New Zealand dollar news. If that's the case, I would already want to go into the lower time frame right here, for example. I would already want to go into the 4 hour to now look at a 4 hour value gap to continue higher off of that. But if today doesn't have news, if today also is a Friday, for example, or it's a Monday, it's not really known as a trending day. And trending days are usually Tuesday, Wednesday mainly, Thursday, yes, but the trend can end on a Thursday. So it's very important to understand which day we are actually looking to trade right there. And the day right there that we are looking to trade, that we are looking to expand and create a breakaway gap is a Friday right there, which is usually not what I like. That's the same for Monday, what I went over in the beginning on dollar. I like to wait then that Monday to see if it wants to consolidate, to then look for a new value gap. So ideally, I want to look for a new value gap higher right there going into next week. Now, if we do take a look at the 4 hour, then what can we continue higher off of? We have a fair value area right there and a fair value gap right there. Seeing that this is already just a whole premise behind the daily fair value gap right there, I would already want a little bit more confirmation. Simply because it doesn't have news. It's a Friday as well. Very tricky in my opinion right there. And if we go into the lower time frame, let's see if we have something to deal with right here. What are we dealing with? Ooh, that's interesting price action actually. Not a lot of wicks. Very, very blocky price action. Interesting. Let's see, we have a sharp turn right there. Now, oftentimes, small little detail as well, if a sharp turn does not have a perfect straight after right there, that's not something I would like to get involved in anymore, or at least I would want, again, more confirmation. The bigger the consolidation before we actually make a rehire, for example, right there, usually the worse the sharp turn is, because a sharp turn is a sharp turn. It's not a bulky turn. It's not a consolidating turn. It's a sharp turn, and a sharp turn happens quite fast. The low probability conditions right there should always take longer before we actually want to move higher. And the high probability conditions should always take fast. That's why we have a sharp turn in the market. So it's an interesting and quite important detail as well when we do get into confirmation. Now, right there, eventually we try to push higher, and yeah, it's typical Friday price action where it's just a consolidation, usually ends the week as well right there. Let me know if that makes sense. That's why I would indeed, if I were to trade it, yes, I would definitely want to see more confirmation, more price action, 100%. If there's resistance in the form of unmitigated PD raise, for example, once the rejection of it is over, would you drop time frame for new context? Because sometimes after resistance, price explodes without a real chance to get involved. I'm just wondering how you go about that, because resistance is a topic I struggle with. That's a really good question. That's quite an advanced question as well. So, and the reason I say that is because it shows that you have definitely a good understanding already, because it's an advanced question. So in a case like this, for example, where let's say we are still trying to catch the move and all the resistance is gone right there. Now, when the resistance is gone, essentially when we drop below this low right there, and we can continue lower, we can indeed go down time frames to find new context, especially in a flow trading plan right here. We can find 15-minute or 5-minute to try to catch that last move, because we also know it will most likely run. So we can even wait towards the last piece of price action, where right here, the 5-minute right there leaves behind a last little sting before it actually enters the no resistance zone, where we can also see the no resistance is right here, is started in this gray box. But in this leg higher, we also have, resistance essentially, right? So the last resistance that we have before we reach that no resistance run zone right there is that swing low. So once we reach that and we see, all right, we also disrespect that value gap, 2 candle rejection, failing, we continue lower, create a new 5-minute fair value gap. That in itself can also be an entry. So to answer your question as well, yes, we can indeed drop time frames to see if we still want to look to enter right there and to find a new entry as well. Yes, for sure, 100%. In second order flow lag, the fair value gap of second order flow lag should be lower than fair value gap of the first order flow lag. How intense is it? In second order flow lag, the fair value gap of second order flow should be lower. It depends if we're looking at bearish order flow lag. Yes, ideally. For example, sometimes we get a sharp turn like this. Let me draw it out. We get a sharp turn like this, where we have a sharp turn and we create new order flow lag, and the new order flow lag is inside that first order flow lag right there. This is something I do not like personally. Unless the higher time frame is very clear and we already can enter, etc. But it shows just a lack of intention right there. And the reason it shows a lack of intention is because if we measure oftentimes the first sharp turn lag compared to the second order flow lag right there, it's just half of it. It's very small. And when that is the case, it just shows lack of intention on that second order flow lag right there. So oftentimes what I actually mention is the bigger the sharp turn, the worse the order flow. And the reason for that is because the bigger the sharp turn, the more difficult it's going to be to enter actually on the second order flow lag lower right there, because most likely it's going to be a very small one right there, which makes it less accurate, less intention as well. It's all things that I do not like. Now, ideally, I want to see my order flow lag like this right there. Also leaving behind a fair value area right there, which we can now continue lower off of. And it's just simply said, it's more intention towards the downside. So it's that pushing battle. That makes sense. So that is how I would want to view that. Let me know if that makes sense and if that was the question actually. Oftentimes for me, the 2 candle rejection is not reliable. I need 3 candle rejection, but that is much time to wait for. Maybe it is just me thinking this way. It depends on the scenario, I would argue. Depends on the scenario. I personally only stick to the 2 candle rejection. For me, it is very reliable. So it really depends on the scenario overall. But of course, you don't have to wait for that, right? If we are looking at the dollar, for example, right here, where is it? Lost. Then on the daily time frame, if we want to continue higher off of that daily fair value gap right there, I am not necessarily waiting for 2 candle rejection right there to then get involved. I'm already scouting on the lower time frame. What can we do right here? Are we already creating that 4-hour fair value gap higher right there? If it's even a context area, we can already go into the 1 hour right there to find a 1 hour sharp turn, or even a 15-minute sharp turn plus re right there to continue higher off of that instead. And that will create, in turn, the order flow on the low time will in turn create the candle signs, the 2 candle rejection on the higher time frame. That makes sense. But 3 candle rejection, of course, is a good way to go about it. It's not necessarily bad. It's extra confirmation, I would argue. It's a good way to go about it. I think in that sense, you could actually be correct, because in that sense, if we have a 2 candle rejection compared to a 3 candle rejection, if a 3 candle rejection is not following through as well, then that's a good sign that we actually do not want to enter the trade. So I do like that. I like that. Yeah, I think it depends also on the second candle for sure. It really depends on quite a lot of variables, of course. Do you think you can trade a mitigated fair value gap if the second candle that touch it sweeps the lower high of the previous candle that first tapped into it? And by the way, the bigger the sharp turn, the harder you know price will retrace before it actually reacts, right? Exactly. That second statement is very true. And by the way, the bigger the ST, the harder you know price will retrace before it actually reacts, right? Exactly. Usually the bigger the ST is, oftentimes it's finding that perfect balance in a sharp turn, which is, it's a bit subjective, but it is what it is in that case. But the bigger the sharp turn is not always a good sharp turn. And that is something that we need to understand as well. To answer your first question, yes, it's exactly what we go over in candle signs actually. So you can trade a mitigated fair value gap, but you're not actually trading the fair value gap anymore. So if we have a low close inside of it, for example, Russell right here, at that moment in time, when we look at this situation, when we close below that fair value gap, as soon as we touch into that fair value gap, it's done. It's done for. It's not valid anymore. It's now mitigated. It's nothing anymore. So the only discount rate that we have left inside that fair value gap is the previous candle low right there. And that's what we go over quite in depth in candle signs as well. And it's the same for if we leave that behind right now, and let's say we create this candle close, then if we now want to continue higher still, is not the fair value gap that we're going to continue higher. So it's not the 50% right there. And oftentimes that 50% coincidentally lines up with a sweep of the liquidity right there of a swing low, which we leave behind in a fair value gap to then continue higher off of that instead. So it's the other discount rate that's left behind inside the fair value gap. All right, let's see. Let's go over some of the pairs right here. Now, on Australian dollar, US dollar, I want to compare them a little bit. And the reason I want to compare them is because oftentimes a big part about trading is as well selecting the right pair to actually trade. And what I mean by that is we have AU, we have EU, we have GU, we have New Zealand dollar, US dollar, we have US dollar, Canadian dollar, US dollar CHF, US dollar JPY. So which one of the Forex majors are you actually looking to trade? You ideally want to trade the one with the least resistance, with the nicest price action, the nicest rejection, the perfect candle signs. That's the one we ideally want to trade. So if we compare those right here, then if we take a look at GU, GU is already a little bit more irrelevant. And what I mean by that is it doesn't have a clear premium rate to continue lower off of. Yes, it has this fair value gap right there, but that fair value gap is quite a far retracement to actually continue lower off of. So if we take a look at EU right here, EU actually had a perfect fair value gap on Friday right there, I believe, on Monday, created to then sting into it to then continue lower off of that. Where GU doesn't have that. So it's a little bit more tricky to trade that. It's a small little detail which is quite important. And if we compare both of them to AU right there, now AU could also be interesting, which also has that fair value gap. So what is then the differentiator between AU and EU? That's how strong one is, or how weak actually one is. Because right here we see AU is creating this fair value gap actually before we reach that low. Very similar to a scenario like we have when we create a big ST right there and we create a small order flow lag inside that. Very similar. It shows a lack of intention actually wanting to continue lower. I do not like that. So ideally, in comparison to EU right there, it takes out that low. And no, that's not SMT or anything. It just shows you right there that this is weaker. So this is the one I want to be trading if I do want to look for shorts right here. It's a small little detail, but those details they really matter when it goes about entering, because that's when the stop loss is getting involved. And when the stop loss is getting involved, of course, we might get taken out before we actually get the real move. So right here, we might have a big chance to get taken out before we actually get the real move. We get more choppy price action before we actually continue lower as well. Where EU is more bearish, and simply said, it's leaning more towards the bearish side because it's stronger. It's weaker, actually. It has the weaker price action. It's stronger on the bearish side and not stronger on the bullish side in that case. That's quite important to understand right there when we do start going on about the filtering process as well. Filtering process is something we are going to go over on later on in the execution month as well. Important to know which pair, which instrument you actually want to look to trade. Is two candle rejection thought in spring roll? Yes, for sure. Yes, candle science video, perfect. Could you give more examples of low resistance conditions? For sure. Let's actually see. Let's see. Let me see if we can find one in. Is that low on AU, not just the context target though? Let's see. Yes, it is, but it's what we went over actually in this live session a little bit earlier. If we want to reach this context target right here, then that context target should have already been reached. As in, we do not need to, the retracement here to create this daily fair value gap right now to then continue lower off of that is bigger than actually following through towards that drawn liquidity. As in the volatility needed for that is bigger than actually just to simply follow through towards that low. So that's already suspicious, where usually the case when we do move from context to context low right there, what we leave behind is a breakaway gap right there to then a fair value area overlapping with the exact low to then continue lower off of that. So it's usually a fast move right here, right there, to then continue lower off of that. That's the ideal scenario what you would want to see. Creating new same context in already moving context, that's extremely suspicious. This is just a sign that it is stronger right there which is a sign that we are going to most likely have lower probability price action in comparison to something like EU right there, where EU takes out that context fast movement, exactly what we want to see, not a daily value gap created inside that bigger context. Then right here, we continue lower off of that value gap, which is exactly perfect. That's what we want to see, which is simply seen as well by EU right here is weaker. It's stronger to the bearish side right there. There's more bearish intention. AU doesn't have that. When we have more bullish intention right there in a bearish market, that can only create consolidating price action, ugly delivery. That's not something I am interested in. It's a small little detail. Let's see, can you give more examples on resistance? Yes, I think crude oil right here is a good example. So to understand resistance and the way I look at it, I always look at the previous range before we actually continue lower. So a funny, interesting thing actually is I do not necessarily look at what we are going to continue higher off of. I just look at the no resistance run, which already tells you when we are actually going to continue higher. So what I mean by that is, if we want to continue higher, then in that lag lower right there, we might have some form of resistance before we actually have this move higher right there towards, let's see, that daily swing high. It's actually quite interesting because that daily swing high was actually reached a little bit earlier. What happened right there? When we looked at the live session, it was actually reached. Anyway, let's see. So on the 4 hour, what do we have? On the 4 hour, we have this same lag lower, and we create this 4 hour value gap right there. We have this order block sitting right there as well, which are the only areas we can really trade off of to potentially continue lower a little bit to then continue higher. So what do I mean again with, well, I don't really care where we are going to continue higher off of right there. I don't really care about the accuracy. It's because in this lag lower right there, we also have resistance areas. What are the resistance areas here? Well, we have this. This was already mitigated right there, where we continue lower off of. We have this fair value gap, which we already tried to push lower off of. Then the only area we have is this small little order block right there, which is getting a significant move lower right there, which I also personally did not expect, but doesn't really matter. Then as soon as we start to take out premium arrays on this lag lower again, and the resistance right there starts to fill. So we have these resistance, they start to fill, took a rejection, we start to continue higher. Then right there, this rejection right there, it's the last rejection before we actually start to approach swing highs right here. And the swing highs, I'm not too worried about, because those swing highs, yes, we can potentially see somewhat of a rejection, but not as big as an order block, as a fair value gap that's unmitigated. Those swing highs, yes, we might mess around a little bit, create a fair value area to then continue higher off of that, but we won't do anything significantly crazy. So right here, this area right now, let me show it clearly. The last resistance area, which for me is that order block right there, that is where we create a 2 candle rejection. Once we take out that 2 candle rejection right there, above that high is where we would want to look for price action to run. So that's where it's going to happen very fast. So ideally, we want to get involved before that area, no matter how we do it, as long as we get involved before that area right there. And that's where we start to run right there towards those highs, because we have no resistance anymore left. So why doesn't it matter what we're going to continue higher off of? Because as long as we get involved before that last form of resistance right there, before we have no resistance anymore right there. Similar example is on gold, which right here, if we take a look at this, I'm not sure when this was on Monday, I believe. On the 4 hour, we have this small little order block right there, which we sting into. Now, above that order block, above that 2 candle rejection right here, we have no resistance anymore right there until we reach that fair value gap right there. That unmitigated fair value gap right there. That's where we get the first resistance again. This fair value gap again, not relevant. We have that swing high in it, yes, but again, I'm not too worried about swing highs usually and swing lows. So this lag right here, I'm not too worried about what we're going to continue higher off of if I'm trading this. All I'm worried about is getting involved before we reach this gray box right there, because I want to catch this move right there. So for me, you could simply wait. You could set an alarm as we get close. You set an alert right there. And as we get close towards that high right there, simply press buy right there, place your stop loss to then get involved to catch that move. So it's of course an exaggeration, but then in this leg, we do the exact same thing right here. In this leg lower, all right, if we want to continue higher, what can we, how can we continue higher and what resistance are we encountering right here? We have this fair value area right there, which we are already taking out. We have this fair value gap, 2 candle rejection already failing right there. Above that, we have this order block, which is the last resistance again. Let's dive into the lower time frame. What do we see? We have this 50-minute fair value gap right there. See on the 5-minute, do we have any sort of rejection? We do not reject even off that order block right there. We immediately continue higher, target that no resistance run right there area. That's exactly where an entry where we have a lot of volatility going high right there, that's perfectly fine to get involved. That's how I personally look at the no resistance runs and no resistance areas when we do not have any resistance anymore. Let me know if that makes sense. Those are the low resistance conditions that we mainly have throughout this week. How would you enter on? Oh wait, let me see. Since the fair value gap is not valid anymore, how would you trade the liquidity sweep? For example, daily PD rate gets mitigated. Wait for next candle to go below the previous candle, go to 4 hour, or do you go straight to the entry time frame and look for ST plus V? In a situation like this, you can go straight into the entry time frame right there, where we suit the previous day low. That for me is perfectly fine to go into the entry time frame because we close late during the day inside the fair value gap. So perfectly fine to go straight into entry time frame. In a different scenario, where we mess around a long time and for example, we came back with that down candle to then sweep it again, then I would want more confirmation. But since the original idea is still of that fair value gap, if the original fair value gap for you was already enough to dive into the lower time frame, then the previous day low inside that same fair value gap where you were already willing to go into the lower time frame is also perfectly fine to go into the lower time frame. What I would want to see on the lower time frame, that's an important detail, is that sweep below that low. Yes, right there, but it should come back above that low as well, indicating that it is indeed sweeping that low. That makes sense. How would you enter on EU? How would you manage the trade? So here on EU, let's see. On EU, we had this bar of value gap, which was actually quite interesting because we had a nice 15-minute sharp turn off of that. So I'll just use this as example right here. Now, once we come into that, I would want to enter off the first fair value gap right there. I would not specifically use that fair value gap right there. For me, it's always the first fair value gap right there. Covering the bodies, that is something I like to do as well, since the entry is also a little bit lower, covering the bodies right there. Then targeting a 1 to 2, which is still inside the bigger context. It's not in the 4-hour context right there, but inside the bigger context. So I'm not too worried about that. Now, when would you go break even right here? Since the retracement is a little bit deeper, and since the retracement is indeed a little bit deeper into your drawdown area, usually going break even is a little bit harder. So the more accurate your entry, the more accurate your risk management and the easier your risk management actually is going to be as well. So if your entry is not accurate, which I sometimes tend to have not the most accurate entries, then my risk management is going to be a little bit harder. But I do not really mind that because I'm good at risk management myself. So right here, the way I want to look at my risk management is candle signs, and it's mainly when we have new fair value gaps going lower right there. So this is actually quite an easy example because we hit take profit before you even get the chance to do anything else. But right here, we create this expansion phase right there. Now, if I were in a trade ID, that is quite important to me. As in, we remind ourselves of the entry level. That right there should now create a fair value gap. So any movement below that, if this already becomes a breakaway gap, for me that's enough to now go break even. Why? Well, this area is actually also, once we reach these lows, is the no resistance area, which is also, funny enough, overlapping with the previous question. This again is the no resistance area right there, below that low, where the only rejection that we're seeing currently is that order block right there. We continue higher a little bit right there. We fail to continue higher off that fair value gap. Perfect. Then as soon as we trade below this low, actually, if we're being more specific, as soon as we trade below this low, we take out the 2 candle rejection right there. That is the no resistance run towards the next resistance that we run into. So what do we run into right here? Something like these swing lows or block right there. Perfect. So That right there is where we can now assume, all right, if that is going to be an expansion phase candle, next candle should just continue lower right there, going to be leave behind the breakaway gap as well. So that is where we can already go break even quite early on as well. Oftentimes, people underestimate how early you can go break even, because believe me, you can go break even really, really, really earlier on than you actually think. Oftentimes, let me know if that makes sense. When two pairs are high probability, both equally convincing with time agreeing, let's say EU and AU random pairs, would you look at Euro Australian dollar to choose one pair or enter a position in both? I don't like being in two positions at the same time, so ideally I would like to avoid this or do something else. It's a really good question. I would argue I'm a very, I'm an extremely picky trader. So if you can convince me that both are equally as high probability, I would love to have that argument, because I think that's very rare. That's extremely rare to have that scenario. But in the case that it's actually true, where they're equally as high probability, then I would, that's a good question actually. I would just look to enter the one that has extra news. So Euro Australian dollar, US dollar has the news most likely if we're looking to trade EU and AU. Then let's look, does EU, or so Euro or Australian dollar, also have news supporting the ID? And between those two, then I would look at, all right, if Euro US dollar has Euro and US dollar news, I would want to trade that one. If they both have that as well, yeah, then pick the one you like the name more or something like that. It doesn't really matter. Then it becomes, again, a time, all right, in which kill zone are we entering? So how much time? I would argue if I were to look at both and we have Australian dollar news and we have Euro news as well, I would go for AU. And the reason for that is because EU has more specific times that's actually running at, where AU, I can leave it alone in Asia session and I would still be quite confident that it will reach my target as well, because it's just more volatile in Asia session. So the small details. It's an interesting question. I like that though. Does no resistance run have been my bread and butter lately, Chico? Yeah, it's I really like that myself as well. As in, for a flow trading plan, it's the only thing I do essentially. I don't even really look what we can continue lower off. I just focus on those no resistance runs. It's the only thing I trade. For flow trading plan then. I posted in the chat, support already held on it and convinced, but it will be great if you give examples on this two condition for setting up fair value area. Let me see. Let's see. Here there's a small gap, but the swing low is overlapping with the wick of the fair value gap candle. Let's see. Here's small gap, but the swing low is overlapping with the wick of the fair value gap candle. Let me share my screen as well to go over this. Here there's a small gap, but the swing low is overlapping with the wick of the fair value gap candle. I'm not sure what I'm exactly looking at, as in where that's a small gap right there. I can see that, but where's the swing low is overlapping, is not or is overlapping right there with the wick of the fair value gap candle. Let's see. In this case, the third candle of the fair value gap is overlapping with the swing low. Open candle should be considered. You just, in this case, the fair value area. So if we do not have, let's go over this. If there's a fair value gap and it's not overlapping with an exact low of the wick that we just took, so for example, right here, this low, this is not overlapping with a fair value gap. So the body of the fair value gap. So that means this area right here, the meat of the fair value gap right there, the actual fair value gap. If that's not overlapping with the exact low, then always refer to bodies right there instead of the actual wicks. So same scenario right here. Now this scenario where we have a wick overlapping right there with the exact body of a fair value gap, that's where you can use the wick right there. Same for this right here, for example, right there. And if we look at a few more examples, let's see, this high, if we were to continue higher, that high right there is not overlapping with an exact fair value gap. So you would use the bodies right there. And similarly, this right here, this wick is exactly overlapping with a fair value gap. So that's when we use the wick right there. If that makes sense. I'm not sure if that was the question. Perfect, perfect. Thoughts on AU 1 hour flag from 4 hour flag did not get involved because could not see what dollar was doing and also did not want to blow the profit for the week. Let's see. AU right here on the 4 hour fair value gap. Let's see. I imagine it's this one right here. As soon as we take out, so it's already, I imagine it's this one. As soon as we take out this context low right there, and as soon as we do take out the context low and we have price action like this, I never like trading outside of any new context. So usually what you see me do is when we take out some form of context, I just want to wait for new daily context, new weekly context, whatever it may be. But right here, another argument that we can make is that we are now not running that low, we are potentially sweeping that low. So here, coming into this, we are creating actually a 4 hour flag up as well, which is not too worrying. We can still continue lower, but that lines up with the dollar like we mentioned as well, and like you actually mentioned as well. So any 1 hour flag up lower off of this for me is not that interesting, purely because we have now reached that daily context. If this was inside of bigger daily context, I would say yes, that is quite interesting. But if it's only based on 4 hour context after reaching already daily context low, potentially sweeping that instead, that's not that interesting to me. So if it was, for example, let's say EU right here, where we're still moving inside that context, and we have this sting into this 4 hour fair value gap right there, we're still moving towards this context low. So we have still some price